We are going to deal with the year-end adjustments for income this week. Now, I just quickly want to remind you why we are doing year-end adjustments. The first reason is because we want to give the owner realistic financial results of the performance of its company during this year and the company's financial position at the end of the year. It doesn't help that we sugarcoat things. He needs to know exactly where the business is at the end of the year. Next reason is GARP principles. Now, I know when we say GARP principles, most of you groan, but they are what we base everything on in accounting. Okay, so the GARP principles that we are focusing on with year-end adjustments is consistency. Okay, so we have to have consistent financial results every year or consistent financial applications. So what we do is we do these specific year-end adjustments and we do them every single year so that the financial statements of 2 years can be compared. The next one is prudence. Now remember, prudence says rather understate than overstate. And matching. Matching is probably the most important one, which says that all of the expenses that we have incurred in a financial year must be matched to the year when the income is earned. Okay, so in other words, if we spend money to enable us to generate income, then the money we've spent must be recorded in the same financial statements as the income that we've earned. That's it. And then the third one is what we will base this section and next week's expenses section on, and that is that net profit is determined by income that we have earned and expenses that we have incurred, not the cash received and paid. Okay, so it's not about our cash flows, it's about our profit, and profit says how much money have we actually earned minus how much money have we actually spent, regardless of whether we transferred the cash. Now, every company has a financial period and we use that financial period to set up the financial statements, and it's a period of 12 months for which the financial position of the business is determined. So what I did is I made it fairly simple. I started my financial period on 1 January 2020 and ended it on 31 December 2020. Okay, but there are many companies that follow a different financial period. Most of them go with the tax year, which starts on the 1st of March each year and ends on the 28th of Feb the next year. Or some of them start in the middle of the year. But regardless, it must always be 12 consecutive months. Now, the reason why the financial period is so important is because we focus on these specific 12 months. And the golden rule is if something happened in these 12 months, it must be on the income statement for this year. If it didn't happen in these 12 months, then it shouldn't be on this year's income statement. Okay, so if it happened before January 2020, then it should be in the previous year's financial statements. And if it happened after December 2020, then it should be in the next year's financial statement. And what I'm going to show you in this slideshow is how to ensure that all of the income that we've earned in the financial period is on this year's statement and nothing else. No income from last year or next year. Okay, so it's important to remember that income earned is recorded regardless of whether the cash was received. Now, there are two possible options for income. The first option is accrued income. Now, what that means is that we have earned income, but the client hasn't paid the business yet. Okay, so the client actually owes the business money for something that the business already did during this financial period. And the other option is that we haven't earned the income, but we received it in advance. In other words, the client was a little bit trigger happy or over eager and already paid the business for something that the business hasn't earned the money for yet. Okay, so accrued income says that the business earned the income during the current financial year, but the income has not yet been received, and it must still be brought into account, okay, because we earned it, the service was already taken place in this financial period, so it must be on this year's income statement. Income received in advance says the business received income that relates to the next financial year, and therefore it cannot be reflected in the current year's financial statement, so we will have to take it out. We haven't earned it in these 12 months, so it can't be on this income statement. Okay, let's go and look at them individually. Accrued income means that the client owes the business money. The business already did our part. We rendered a service, or we rented a building, or we had money in a fixed deposit that we earned interest on. We just haven't received the income yet, physically, the cash for it. Okay, so the client actually owes the business. It's very similar to debtors, but it's not debtors, don't get confused. And if someone owes the business, it's an asset for the business. We can just sit back and wait for the money to come in. Okay, so we have to go and make a general journal entry. We debit accrued income because it's an asset account and assets increase on the debit side. And we go and credit the specific income account that relates to this adjustment. The reason why we credit the income account is because income accounts increase on the credit side. So we want to make that income account more, even though we haven't received the money yet. Let's look at an example that might make it a bit easier. So it says the extract from the pre-adjustment trial balance. Now what the pre-adjustment trial balance is it's the trial balance that shows all of the money in all of the general ledger accounts at the end of the financial year, but before we started doing all of these adjustments. Okay, and it's on 28 Feb 2020, which just shows you that this financial year ran from 1 March 2019 up until 28 February 2020. The value for rent income is 12,210 Rand, and that's the value that we have received from our tenants in this financial period before we are adjusting it to show the value that we have earned in the last 12 months. Then the adjustment says rent for February 2020 has not yet been received. In other words, this 12,210 Rand only reflects rent for 11 months because we haven't received money for February 2020 yet. Have we earned it? Yes. The tenant used the building in February 2020. He just hasn't paid us yet. Okay, so you have to quickly go and calculate the value for the rent for February 2020 because we have to go and record it. It must be on this year's income statement. How do you calculate it? You divide the 12,210 Rand by 11 because it only reflects 11 months, which shows us that we still need to receive 1,110 Rand of rent for February. In the GJ, we go and debit accrued income. It's an asset account because the tenant owes us that money. It's in the balance sheet section. And we go and credit rent income. The reason why is because that's where rent income will increase, and we have to increase it by 1,110 Rand to show the true value that we have earned in this year. Your narration is super easy. It says rent income for February receivable or accrued. I would stick to the word accrued because it's the same as the account's name, so it's less things to remember. You can also just say rent income accrued. You don't have to say for February. Next example, it says that we don't know what the rent income value is on our pre-adjustment trial balance. Okay, we can also give it to you like this in an exam. The adjustment says that part of the building has been let for the past 8 months at 745 Rand per month. Okay, so super easy. We know our rent income value must reflect rent for 8 months at 745 Rand per month because that's how much rent we have earned. Then it says the rent for the last month has not yet been received. Okay, so the adjustment that we need to make is we just have to go and record the rent for February 2020. What is the rent value? 745 Rand per month. Really easy. If we do it, we go and debit accrued income. Why? Because we still need to receive the money, so the tenant owes us. It's an asset. And we go and credit rent income because that's the side where rent income increases. We have earned that money, we just haven't received it. And then you say rent income for February accrued. I would stick to the word accrued. Example says the extract from the pre-adjustment trial balance shows interest on the fixed deposit of 660 Rand. Now remember, that is the value that we actually received for this year. Then the adjustment says the fixed deposit of 8,000 Rand was invested on 1 March 2011. Now 2011 is very far away from 28 February 2020, but the reason why we give you that here is just to show that when this financial period started on 1 March 2019, we already had the fixed deposit. Okay, so we would have earned interest on this fixed deposit for the full financial period from 1 March 2019 up until the end of February 2020. The interest rate is 11% per annum and it's payable quarterly. Now remember, there are 4 quarters in a year. Then it says interest for the last quarter has not been received. Okay, so what do you need to do? You need to go and calculate the interest value for 1 quarter and you have to go and record it as accrued income because we earned it, the money was in the fixed deposit, we just haven't received the physical cash from the bank. Okay, so normal interest calculation, it's the fixed deposit value multiplied by the rate of 11% multiplied by 1 quarter. Gives you 220 Rand. That's the value that is accrued income because we've earned it, we just haven't received it. Go and debit that asset account and go and credit interest on fixed deposit because that's the income account that should be a little bit more. And then remember, because it's now interest, we always want you to give us the time period and the rate in your narration. So interest on fixed deposit accrued for the last quarter at 11% per annum. Now that we have dealt with all of the possible accrued income calculations, let's look at income received in advance. Now what this means is that your client was overeager and paid you for something that you haven't done yet. Therefore, the business owes the money to the client. Not the money, the business owes a service or owes rent for 1 month or whatever to a client. Therefore, it becomes a liability for the business. Okay. In this case, when we make the general journal entry, we will go and credit the liability because that's the side where liabilities increase. Okay, so we credit income received in advance. That's the liability's name. Super easy because that actually tells you exactly what happened. We received the income in advance. It's not for this period, it's for next period. What do we do? Our debit is then the specific income account. And the reason why we are debiting the income account is because that's the side where the account decreases. Why do we want to decrease the income account? Because for this year, we haven't earned that money yet. So we can't have it on this year's income statement. Then we will overstate our profit, which is not true because it's not part of our profit for this year. It's actually income that we will earn in the next year. So we debit the income account, make it less for this year so that we can transfer that value to the next financial year. Let me show you some examples. It might make it easier. Okay, so the extract from the pre-adjustment trial balance on 30 June 2020. So now we just switched our financial year to start on the 1st of July and end on the 30th of June. Shows rent income for 18,200 Rand. Now remember, the pre-adjustment value is always the value that we have actually received. Okay, let's go and look what the adjustment says. It says that rent for July 2020 has already been received. Now what's wrong here? The year, this financial year, actually ends on 30 June 2020. Okay, so We can only reflect all of the rent that we have received up until the end of June. July 2020 is in the next financial period. So we can't show the rent for July 2020 on this year's financial statement. In other words, this 18,200 Rand reflects rent for 13 months. It's for the 12 months of this period plus 1 month of the next financial period. What do we need to do? We have to go and calculate the rent for 1 month, and we have to go and take it out of the rent income account. The calculation, super simple. You divide 18,200 by 13, which shows you it's a rent of 1,400 Rand per month. And if we take it out, we now credit income received in advance because it's a liability. We haven't earned the income yet. It's not even July 2020 yet. So we owe this tenant rent for 1 month, basically, in the balance sheet section. And we go and debit rent income. Why do we debit rent income? Because we now want to decrease the income account. This 18,200 Rand is too much, okay, because it's not all of it is for this year. Some of it is for next year. So we want to decrease it on the debit side by the 1,400 Rand. Then super easy, your narration, you just say rent income received in advance. The last example says extract from the pre-adjustment trial balance on 30 June 2020 shows rent of 10,374 Rand. In other words, that's how much we have actually received from our tenant. Then the adjustment says part of the building has been let to BBAG since 1 May 2019. Why do we say that? It's just to ensure that you know when this financial year started on the 1st of July 2019, we already rented the building. In other words, we need to have rent for the full 12 months on this year's income statement from 1 July 2019 up until 30 June 2020. And then it gives you the rent per month. Okay, so what do we need to calculate? We didn't really tell you. Okay, that's how we will do it in the exam. We will give you something like this and you need to figure out what you need to do. I would say you have to calculate how much rent we have actually earned this year by just multiplying the 798 Rand by 12. Gives us 9,576 Rand. That's how much rent we should have in this year's income statement. Okay, but we have more than that. Okay, so we have to go and subtract 9,576 from the value that we actually have. And that tells you we have 798 Rand of rent that we have received in advance. Okay, so in other words, this value is too big, okay, because we've only earned rent for 12 months of 9,576 Rand. So we have to go and decrease this value by 798 Rand. Where do we do this? In the GJ, you go and debit rent income because we need to decrease it. That value is already received for the next financial period. Credit income received in advance, which is a liability for the business, and you say rent income received in advance. So much. It's actually super easy. You just have to think. Did it happen in this financial period? Yes, then it should be recorded. No, then it should be taken out. Okay, see you guys next week.